Hello, beautiful people, and welcome back to Boni's Life. I'm your host, Boni, and this is your front row seat to the wild, wonderful, and often bewildering world of cryptocurrency. If you've glanced at the markets recently, you know the last 72 hours have been less of a gentle wave and more of a financial tsunami followed by a rocket launch. We've seen a gut-wrenching plunge that had the bears roaring, only to be followed by a spectacular recovery that has everyone asking the million-dollar question, what on earth is happening? Is this a classic dead cat bounce, a temporary recovery before an even steeper fall? Or are we witnessing the defiant beginnings of the next major bull run? That's the mystery we're going to unravel today. We will be your crypto detectives, sifting through the evidence with a powerful combination of deep technical and fundamental analysis. We'll connect the dots between the price charts and the seismic global events that are sending shockwaves through all financial markets. And as always, we'll bring in the heavy hitters, the sharpest insights from highly regarded traders, visionary developers, cautious regulators, and leading financial institutions. By the end of this episode, you'll have a comprehensive 360-degree view of the market's health, empowering you to navigate these choppy waters with confidence. So get comfortable, maybe grab a notepad, and let's dive headfirst into the crypto vortex. Let's set the stage by rewinding the tape. The past 3 days have been a perfect illustration of market psychology, a dramatic play in two acts. Act 1 was a tragedy for the bulls. The market was painted in a brutal shade of red, led by a sell-off that saw Bitcoin, the king of crypto, break below the critical $65,000 support level. This wasn't just a minor dip, it was a capitulation event. The total cryptocurrency market capitalization hemorrhaged nearly $2 trillion in the month of February, a staggering loss of value that shook even seasoned investors. It felt like the bears had finally emerged from hibernation, ready to feast. But then came Act 2, the great rebound. Just when despair was setting in, the bulls mounted a spectacular counteroffensive. Over the last 24 hours, the market has roared back to life. Bitcoin itself catapulted by over 8%, its best single-day performance since May of last year, briefly kissing the psychologically significant $70,000 mark before consolidating around the $68,000 to $69,000 range. But the real story, the one that has traders buzzing, is the explosive performance of the altcoins. Look at these numbers. Ethereum is up over 12%, Solana is scorching hot at over 13%, and even our beloved meme coin, DOGE is chasing its tail with a 9% gain. This widespread outperformance by altcoins is what we call a risk-on signal. It suggests that capital is flowing from the relative safety of Bitcoin into more speculative assets, a sign of growing confidence in the market stability. As Daniel Rice-Faria, the CEO of ZeroStack, astutely observed, the wave of forced selling is starting to clear out. Altcoins are outperforming again, and more of them are ahead of Bitcoin. That tells me we're seeing a rotation. This isn't just a recovery, it's a stampede into the broader crypto ecosystem. Alright, let's put on our technical analyst hats and dissect these charts. For those new to trading, technical analysis is the art of using past price action and volume data to forecast future market behavior. It's like being a weather forecaster for the financial markets. First up, the Relative Strength Index, or RSI. This indicator is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100. Typically, an RSI above 70 indicates an asset is overbought and may be due for a correction, while a reading below 30 suggests it's oversold and could be poised for a bounce. Right now, Bitcoin's RSI is sitting comfortably in the neutral zone around 55. This is actually quite constructive. It tells us that the recent rally hasn't exhausted the buyers and there's still plenty of fuel in the tank for a potential move higher. It's not too hot, not too cold, it's just right. Next, let's look at the Moving Average Convergence Divergence, or MACD. This is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is composed of two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, it's a bullish signal, indicating that upward momentum is increasing. And that's exactly what we're seeing now, an early-stage bullish crossover. This suggests that the short-term trend is shifting in favor of the bulls. However, a word of caution: these signals are most reliable when confirmed by other indicators and price action. It's one piece of the puzzle, not the whole picture. Now let's talk about support and resistance. Think of these as floors and ceilings for the price. The most significant ceiling right now is the formidable $70,000 level. We've tapped on that door, but we haven't been able to kick it down. A sustained break and close above this level would be incredibly bullish, likely triggering a wave of new buying pressure. On the flip side, our immediate floor or support lies in the $66,800 to $68,000 zone. If we fall through that, the next major support is around $62,500. The real danger zone, as warned by analysts at crypto exchange Bitru, is a break below $60,000. Such a move could trigger a cascade of automated liquidations, potentially sending us spiraling down towards the low $50,000. That's the bear case we must be prepared for. For a long-term perspective, we look at the heavyweights, the 200-week and 365-day moving averages. These are the trend lines that separate bull markets from bear markets. During the recent crash, we briefly pierced the 365-day moving average for the first time since March 2022, a signal that sent shivers down the spines of long-term holders. However, the price has since reclaimed it. More importantly, we remain above the 200-week moving average, which has historically served as the ultimate bull market support line. Alex Thorne, the astute head of research at Galaxy Digital, pointed to this as a key reason to believe the worst of the selling pressure may be behind us. He notes that with Bitcoin trading near those crucial long-term averages and a significant portion of holders being underwater on their investment, we are seeing classic signs of a market bottom forming. But as he wisely cautions, bottoms are a process, not a single point in time, and a period of sideways consolidation could still be on the horizon. Now, let's zoom out from the charts, because no market is an island. The crypto market is deeply plugged into the global economic machine, and the recent volatility is a textbook case of macro forces at play. The first domino to fall was former President Trump's surprise announcement of a 15% global tariff. In today's interconnected world, crypto trades like a high beta risk asset, much like a tech stock. When the threat of a trade war looms, investors dump risk and flee to safety. As Jeff May, the COO of BTC, succinctly put it, the tariff announcement caused investors to sell crypto in anticipation of a more serious market decline. Compounding this fear was the drumbeat of war, with geopolitical tensions between the United States and Iran ratcheting up. In times of such uncertainty, the world's oldest safe haven asset, gold, shines. We saw capital rotate out of volatile assets like crypto and into the perceived stability of gold and the US dollar. It's a classic risk-off playbook. This was exacerbated by a concurrent sell-off in the tech sector, highlighted by a 10% drop in Microsoft stock after its earnings report. The high correlation between the Nasdaq and Bitcoin meant that as tech sank, it dragged crypto down with it. But amidst the macro storm clouds, there were some powerful rays of sunshine, particularly from the regulatory front in the United States. The Federal Reserve issued a landmark proposal to eliminate reputation risk as a factor for bank supervisors. This might sound technical, but it's a massive deal for the crypto industry. For years, a shadow campaign, sometimes dubbed Operation Choke Point 2.0, has seen banks deny services to perfectly legal crypto businesses simply because they were deemed high risk to the bank's reputation. This new rule aims to end that. In a powerful statement, Fed Vice Chair Michelle Bowman declared, "Discrimination by financial institutions on this basis is unlawful and does not have a role in the Federal Reserve's supervisory framework." This is a monumental step towards ensuring fair banking access for crypto companies in the US, a fundamental building block for the industry's growth. And then there's the institutional story. After 5 straight weeks of painful outflows that saw a net $3.8 billion leave the newly launched spot Bitcoin ETFs, the tide has dramatically turned. On February 24th alone, these ETFs saw a massive net inflow of over $257 million. This is the smart money re-entering the market. It's a powerful vote of confidence from the world's largest asset managers and their clients. Caroline Moron, co-founder of Orbit Markets, believes this is a pivotal development, suggesting that these inflows combined with a break above $70,000 could completely rewrite the market narrative from bearish to wildly bullish. We also have to talk about the short squeeze. What is that? Well, imagine you're betting that a stock will go down. You borrow a share and sell it, hoping to buy it back later at a lower price. But what if the price goes up instead? You're forced to buy back the share at a higher price to limit your losses. When many short sellers are forced to do this at once, it creates a cascade of buying pressure that sends the price skyrocketing. That's a short squeeze. And that's exactly what happened. In just 24 hours, a staggering $468.5 million in short positions were liquidated, forcibly closed. This involuntary buying acted like rocket fuel for the rally, turning a small bounce into a massive surge. Finally, on the fundamental front for the broader ecosystem, the Ethereum Foundation released its most ambitious roadmap in years. This straw map outlines a series of 7 hard forks planned through 2029, with goals like achieving near-instant transaction finality and scaling the network to handle tens of thousands of transactions per second. This long-term vision provides a clear path for Ethereum's continued evolution and dominance as the leading smart contract platform, a powerful fundamental driver for the entire DeFi and Web3 space. Now, before we wrap up, let me share some actionable insights for the next 24 hours. For the active traders among you, there are several technical triggers to watch closely. First, keep a laser focus on the $70,000 resistance level for Bitcoin. A 4-hour candle close above $70,200 with above average volume would be a strong bullish confirmation, and that could be your signal to consider entering a long position with a tight stop loss below $68,500. On the other hand, if we see a rejection at $70,000 accompanied by a bearish divergence on the RSI, meaning the price makes a higher high but the RSI makes a lower high, that would be a warning sign that the rally is losing steam. For the more conservative traders and long-term investors, the strategy is simpler but no less important. Dollar cost averaging remains one of the most effective approaches in a volatile market like this. Rather than trying to time the exact bottom or top, you systematically invest a fixed amount at regular intervals. This smooths out the volatility and reduces the emotional stress of trying to pick the perfect entry point. As the legendary investor Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. The same principle applies to crypto. One more thing I want to highlight is the importance of risk management. In a market this volatile, position sizing is everything. Never allocate more than 2 to 5% of your total portfolio to a single trade. Use stop losses religiously. And always have an exit strategy before you enter a trade. The traders who survive and thrive in this market are not the ones who make the biggest bets. They are the ones who manage their risk the best. Alex Kupcikevich of X Pro reminds us that the 2022 bear market taught us a painful lesson. It took over a year for the market to regain its previous highs. Patience and discipline are your greatest allies. So, after weighing all the evidence, what's the final verdict? The crypto market is standing on a knife's edge. The powerful rebound, fueled by a massive short squeeze, a return of institutional inflows, and positive regulatory news, is undeniably bullish. The technicals are showing signs of life, and the altcoin market is buzzing with renewed optimism. However, we cannot ignore the fragile macroeconomic backdrop. The threat of trade wars, geopolitical instability, and the market's high correlation to a shaky tech sector remain significant headwinds. As the analysts at Wintermute noted, crypto has been losing ground as capital rotates into defensive assets, and that broader trend could reassert itself. The key battleground remains that all-important $70,000 level for Bitcoin. A decisive high-volume breakout above that resistance could signal the start of the next leg up, a true continuation of the bull market. Conversely, a firm rejection from this level could see us retest the recent lows, confirming that this was merely a relief rally in a larger corrective pattern. My personal take? Cautious optimism. The fundamental developments, especially on the regulatory and institutional fronts, are incredibly promising for the long term. The short term, however, will be dictated by the macro environment and the market's ability to conquer its previous highs. As always, this is not financial advice. My goal is to provide you with the most comprehensive, balanced, and intellectually honest analysis possible so that you can make your own informed decisions. The crypto space is the most exciting financial frontier of our lifetime, but it demands respect, diligence, and a commitment to continuous learning. Stay curious, stay critical, and never stop questioning. That's our deep dive for today. I hope this analysis helps you see the market with greater clarity. If you found value in this episode, do me a favor and hit that like button, subscribe to Boni's Life, and ring that notification bell so you're always the first to know when we drop new content. And please, share your thoughts, your questions, your own analysis in the comments below. This is a conversation, and I want to hear from you. Until next time, trade smart, stay safe, and I'll see you on the next episode of Boni's Life. Boni out.